Imagine you're thinking about starting a small side business, maybe selling handmade crafts online. Before you invest your time and money into buying materials, setting up a website, and marketing your products, you need to figure out if it's actually worth it. You wouldn't want to put in all that effort and end up making less money than you could have just by keeping your money in a simple savings account, right? That basic idea, that minimum acceptable return you need to make an investment worthwhile, is very similar to what we call the hurdle rate in the corporate world. For a company, the hurdle rate is essentially the minimum return a project must generate to be considered a worthwhile investment. Think of it as a financial benchmark. If a company is considering building a new factory, developing a new product line, or expanding into a new market, they need to know if these ventures will actually make the company richer. The hurdle rate helps them answer that crucial question. So, what exactly sets this minimum acceptable rate? At its core, the hurdle rate is heavily influenced by the company's cost of capital. Companies don't just use their own money for investments. They often use a mix of funds from different sources, primarily debt and equity. Debt comes from borrowing money, perhaps through bank loans or bonds. Equity comes from investors who buy shares in the company. Both of these sources of capital come at a cost. For debt, the cost is the interest the company pays on its loans. For equity, the cost is what investors expect to earn for taking on the risk of investing in the company's stock. They expect a return that is at least comparable to what they could get from other investments with similar levels of risk. To understand the overall cost of capital, companies often calculate something called the weighted average cost of capital, often shortened to WACC. This WACC essentially represents the average rate of return a company needs to earn on its investments to satisfy all its investors, both debt holders and equity holders. The WACC takes into account the proportion of debt and equity a company uses and the cost of each. It's like figuring out the average cost of ingredients in a recipe, where some ingredients are more expensive than others and you use different amounts of each. The WACC becomes a primary factor in setting the hurdle rate. Beyond just the cost of capital, another critical element is risk. Some investments are inherently riskier than others. Imagine two potential projects. One is a relatively safe project like upgrading existing equipment, which is likely to generate predictable returns. The other is a highly speculative project, like developing a brand new untested technology. The riskier project demands a higher potential return to compensate for the increased chance of failure, or lower than expected profits. Therefore, in setting the hurdle rate, companies will often adjust it upwards for riskier projects. A very safe project might have a hurdle rate close to the company's WACC, while a riskier project would have a significantly higher hurdle rate to reflect the added uncertainty. In essence, the hurdle rate is the minimum return required to cover the cost of financing the investment and to compensate for the risk undertaken. If a project is expected to generate a return below the hurdle rate, it means the company would be better off simply returning the money to its investors, or finding a different, more profitable use for those funds. Think of it like setting a minimum score you need to achieve on a test to pass. If you don't meet that hurdle, you haven't passed the test. And in the business world, if an investment doesn't clear the hurdle rate, it's generally not worth pursuing. This careful consideration of the hurdle rate ensures that companies are making sound investment decisions that ultimately benefit their long-term financial health and create value for their shareholders.